Hello, my name is Vinay Nadkarni from ClearBridge Investments, and I'm proud to be hosting this webinar titled Variant Perception in a Rising Small Cap Market. If we had a mulligan, I would now say Volatile Small Cap Market with my colleagues, co-portfolio managers Albert Grossman and Brian Lund. As a reminder, ClearBridge is an authentic active manager solely focused on fundamental equity management, providing concentrated but balanced equity solutions that are differentiated from passive and factor-based strategies with ESG integration across our investment platform. We now manage $177 billion in assets at the end of the calendar year across our equity platform. Our format will be moderated Q&A with some initial topics that Albert and Brian will hit, and then you can submit your questions via the chat feature in this web format. We'll try to get through as many of these questions as possible, and we'll follow up with our client representatives one-on-one with any questions we don't get to in the allotted time. Albert, maybe a good place to start is to always give clients and prospects an overview of the long-term objectives of our strategy and how we try to be differentiated from the marketplace and our peer group. So I'll turn it over to you.
Yeah, thank you, Vinay. Thank everybody for your time and attention. And as Vinay said and shows here on the page, I'm joined on the call today by my co-PM, Brian Lund. But I would also highlight that this is a much broader team effort with tremendous resources. Eric Fry, whose picture is not here, unfortunately, is the third member that's fully dedicated to this strategy, and he is an amazing, great investor that helps us every day with what we do. We also rely on ClearBridge's central research team and the other portfolio teams across ClearBridge for the long-term success of this strategy. Our goal today is to illustrate some of our observations about the small cap investing in general, namely the opportunities and the risks we observe in the marketplace today and how we as small cap active managers seek to deliver long-term risk-adjusted returns. Central to everything we do is an investment philosophy that's anchored by our belief that the market is broadly efficient over time. However, from time to time, the price of a stock and the value of a corporation can and do differ. Our investment process is designed to identify such opportunities across the entire small cap universe, which combined with our understanding of stock-specific and portfolio risks, we trust will deliver strong long-term returns. They are principally driven by stock picking. Our strategy is grounded in valuation, which we see as the worth of an asset. The worth of a company is ultimately derived from the returns each company earns on the capital that's deployed. As an aside, accounting multiples, in our opinion, do not tell you anything about the value or the worth of a company. All it tells you is how the market's willing to price such company today. Active management is fundamentally an expression of a disagreement with the market as for the worth of each investment. To express such a view, we begin our process by seeking to understand what's already discounted in the price of a stock. We then explicitly define and quantify what, why, and by how much our views differ from what we've already discounted. This approach, along with a repeatable process that values companies probabilistic across the entire small cap landscape, is what we believe differentiates our strategy. So moving on to the topics of today, for the most part, small cap active managers, ourselves included, have underperformed over the last year plus. And we explore here today what are some of the contributing factors. So let's start on this page, on this chart, by considering the history of how the small cap market has priced companies of different levels of quality. In this chart, what we show is the history of enterprise value to sales multiple, a very crude shorthand for expectations, for companies in the top and the bottom 40% of quality since 1978. The measure of quality here is return on assets, There are other measurements that were considered, and they show very similar results. For many years, as you can see in this chart, higher quality assets were valued at a premium to lower quality assets, which intuitively makes sense given their higher returns. However, as you can see towards the right of this chart, this picture has changed considerably. And we will explore today why that may be, some of the potential explanations for that. On this next chart, we show a few lines. And basically, the lines above, when the line's above zero, those are periods when high quality securities trade at a premium to low quality, which again, it's been most of the history. We do see a big dip during the dot-com era, and then most recently, that reaching unprecedented levels. Why is this the case? Is this a change in how high quality and low quality companies are being valued or should be valued from now on? That's the question that we pose. And we also ask the question, how much does the composition of the index influence the results? The dot-com era, for those that were around to remember, was certainly marked by the rapid rise of newly unproven and unprofitable companies, which we have again seen in recent years. In the current cycle, early-stage small-cap biotechs have found an extremely receptive audience for funding in public markets, resulting in that industry alone accounting for over 10% of the Russell 2000 benchmark. Given that, we also show, we calculate this data excluding biotechs, which is the blue line, the lighter blue line. And this biotech weight may explain some of the magnitude of the recent extreme observations, but the key points stand, and the key points are two. In general, high-quality assets trade at a discount to low-quality ones, however you measure them, whichever sectors and industries you want to exclude. And number two, the market's clearly willing again to fund unprofitable, highly capital-intensive companies with extreme outcomes. No different than when in the dot-com era, the market was willing to fund Webvan and Pets.com. I guess at the end of the day, who doesn't want a lottery ticket with a great narrative? So I'll pass it on to Brian for now to explore some of the potential explanations, further explanations for what we observed. Brian, the floor is yours.
Thanks, Albert. So I'd like to make a couple points just about why it is that the market is currently valuing speculative assets at a fairly high price. First, we look at the equity risk premium. This has run about 4% on average over history. The combination of an equity risk premium that's low and a 10-year risk-free rate that is low is pretty unprecedented in our history. You can see that from 2000 to 2018, basically the equity risk premium adjusted to the drop in the 10-year by increasing, so that the return on stocks was expected to be about 8%. But that has fundamentally changed in the last year, and now we're looking at an expected return on stocks that's closer to 6% as of March 1st. So that is one reason why speculative assets can trade at a higher price, because their future cash flows are being discounted at a lower rate. It makes sense that long duration stocks should benefit. There is another reason also that we used to work with a gentleman by the name of Michael Mobison, who published an interesting paper in December. He's now at Counterpoint Global and Morgan Stanley. He pointed out that the value of the stock is basically the combination of two things. One, the estimated value of its existing business, and two, the market imputed value of the real options that that company has. The way to think about real options is, say, there's speculation that Apple might create an electric vehicle. That is an option that they have that they can either do or not do. They can do it now, they can do it later, and that the value of that option is a combination of what the value of that vehicle would be, what the cost of that vehicle would be, and then the other components of option valuation, which are basically volatility, the risk-free rate, and time. Well, we can observe that all of those things are somewhat beneficial to real options right now, making options the most expensive that they've been possibly in our history, at least of the modern era, because one, the valuation of the project is high because the discount rate is so low. Two, the cost of that option is low because the cost of capital is so low, both debt and equity for Apple. So it's historically low cost time to invest. And three, the volatility in the market is extremely high. This is an example of the Russell 2000 volatility, which is showing you the volatility in the stock market. It was around 20 in the VIX between 2016 and 2020. That jumped, roughly doubled in the past year, which has increased the value of options across the board. And options come in different forms. They're the options to do a project, to delay a project, to invest more or less in the project that they're doing. So this affects biotech companies. It affects MicroStrategy when it's thinking about issuing equity to buy Bitcoin. It affects GameStop when it hires a new person to run its e-commerce. Like, that creates a whole new set of options that the market is currently valuing at about $5 billion. This is not, I mean, we observe this, and I think it's justified. It's like there are values to these options that are real. Our process, though, calls for preservation of capital first and foremost, and paying high prices for options is a recipe for permanent capital impairment should the cost of capital and or volatility go back to where it has been normally over the past 30 years. This is a very unusual period where those two factors have negative correlation rather than a positive correlation. In the past, we've seen spikes in volatility when the market was afraid and the cost of capital was going up. Here, we're seeing exactly the opposite, which is much more similar, as Albert said, to the market in 2000. So it has been difficult, I think, for all active managers to participate because it is very unattractive to pay high prices for these kinds of options. And that's where I would end that. Vinay?
Yeah, so I think that's a great framework, kind of what's happened in the market kind of over the last 15 months. I think it's a good place to kind of transition from what you have been as a team. As you said, Albert did a great job saying it's not just the two of you, it's a team you leverage. How does that lead to what you guys are thinking about on a day-to-day basis from an idea generation standpoint, kind of your current portfolio positioning and kind of performance expectations? So Albert, maybe that's a good place to kind of transition with our next set of topics.
Yeah, perfect. We'll both explore a little bit of this topic and then take your questions. So this next exhibit shows the strategy sector weight as of the end of 2020. By and large, sector exposure for us is the residual evaluation-driven stock picking process. We are certainly aware of key macro trends, and we seek to incorporate that awareness, whether it be, as a couple of examples, whether it be interest rates or commodity prices. We seek to incorporate that into our probabilistic approach to valuation, explicitly valuing each company under a wide range of potential outcomes. One distinction that we do make across sectors is for sectors of industry and/or industries, they are more highly correlated and tend to be macro-driven. An example would be something like utilities. We do have a preference to have lower deviation from our benchmark weight over time. However, we're talking about, again, real options and things that are much more idiosyncratic. We do accept considerably higher deviations from our benchmark weight for those sectors that are more idiosyncratic. In our view, no risk mitigation is achieved by being equal weight an industry or a sector such as small cap biotech. This is the ultimate idiosyncratic asset, and our performance can only be achieved through stock picking. We actively measure the strategy's exposure in every way we possibly can to better understand the risks that we take. Such exposures, whether it be sector, industries, characteristics, and other measurements, are then used to prioritize the work we do in specific investment candidates. So one example that jumps out of this page that we can speak about changes in the portfolio is, as you can see here, our underweight in consumer discretionary at the end of the year. And well before that, it had led to a considerable amount of work done in a wide range of investment candidates. And that resulted in a few new investment positions in the fund. One example being Blooming Brands, a restaurant owner-operator that has become part of the portfolio. So I'll pass it back to Brian. He has a few closing remarks, and then we'll take your questions.
Yeah, to the question of what we think of performance expectations going forward, because the capital is lower, the cost of capital is lower than the historical average and the historical returns, I think it's reasonable to expect that there will be lower average returns in the future. JP Morgan put out a paper this past weekend estimating about a 4% return over the next 10 years for the S&P 500, which is, bound to be disappointing. However, because there is this high spread between low and high quality stocks in the market right now, a concentrated portfolio that focuses on the reasonably valued areas of the market may be able to generate excess returns over the next 10 years. We are finding as many, if not more, ideas now that are attractive investments, but if they don't have any kind of perceived real option and they're generating a lot of cash right now, they seem to be given very low valuations. So we're very happy with our portfolio as it stands, and I think we have a very good opportunity to outperform over the next decade.
So let's take some questions here. If you guys kind of prepared comments were kind of good. I think the thing I would start with then is something you just laid out, which is that there are some things that I think are really unique to the small cap market right now. And you had said it before about 2000 and the speculation. One of the things that we've heard people talk about is, when you've seen this volume of SPACs come to the market, is that leading to an unhealthy or unnecessary level of speculation? And yet you guys, as befitting your process to really cast a wide opportunity set, actually have been opportunistically looking at quite a few of these companies. So I just thought maybe I'll leave it to either one of you who wants to take the first stab at what you've seen kind of in the SPAC market, or just general views on public versus private valuations, right now.
Sure. Yeah, I'll take a stab at it. I think it is sensible that SPAC should be created now. Again, that low cost of capital, and talk about buying an option, that's exactly what a SPAC is. You put your money in and you get to see what they will target as their acquisition, and if you don't want to buy it, you get your money back. So it is very much buying an option. To us, it's a vehicle like any other. The fact that there are so many of them right now, just like when there are a lot of IPOs, means that, capital is flowing freely and there's lots of speculation going on. That is, inherently a sign that we're in a pretty overheated market. However, it's a little different from IPOs, and I've heard it badly explained in the media recently that SPACs, somehow represent necessarily companies that are too immature to go public by themselves. That is not the case. SPACs are basically private equity in the public market, and private equity can be used for venture, or it can be used to buy a well-established company. We have invested in several companies that have sales in the billions of dollars. Utz Brands, which went public through a SPAC, and Advantage Solutions, a marketing company for packaged goods. Both of those acquisitions brought a huge amount of value to the owners, the previous owners, because they provided a vehicle where they could raise a very substantial chunk of capital, like 40% of the enterprise value, which is very difficult to do in an IPO or anytime soon after initiating an IPO. So They were able to clean up their balance sheets. They were able to pay off founder families, and that made sense for them to do that. They also paired with very experienced management in their industry. So US was bought by a SPAC that was founded by the people who used to run Pinnacle Foods, which was a very successful packaged goods roll-up that ended up selling a few years ago, and those guys went to start the SPAC. So they are getting a very experienced management team in the SPAC. In the case of Advantage Solutions, very similar thing. The SPAC that bought them is being run by a guy named Jim Kiltz, who used to run Gillette and ran several other important packaged goods companies before that. So they're getting very experienced people in the industry. There are lots of very questionable business models, and we look at them and we reject them. And they are definitely getting a lot more funding than they deserve, and they don't look very differentiated, and there will be a lot of disasters that come out of it. But there are definitely good companies that are going public by the SPAC model, and sometimes because they're viewed through this lens of how they went public as opposed to what the fundamentals of the company are, we're getting opportunities to invest at very attractive prices.
So Albert, maybe a follow-up to something that I think is, right, I would say at least more unique to the small cap market, although it feels like it's going everywhere now, is this idea of stocks that have been more heavily shorted, right, and what can happen in a reversal. One of the things in working with you both of you as long as I have, is just kind of how you think about market dynamics. As fundamental investors, are there, knowing that the market has a slight game theory aspect to it, are you spending more time? Are you having to think about some of these kind of short-term issues a little differently? Or what has been the debate amongst the team on things like that, about heavily shorted stocks or other market dynamics, technical market dynamics that are happening right now? Maybe I've gobsmacked Albert. I don't know if we lost him.
Sorry, no, I'm here. Sorry. Apologies for that. Yeah, we've certainly seen this year, as everybody's noticed, things like GameStop and others heavily shorted stocks. And again, maybe Ryan, maybe it is a sign of the 2000s again, from the standpoint that we had chat boards at that point that were driving stocks as well to levels that turn out to not be sustainable. That is not the claim here. I think the heavily shorted stocks to us, and having, in my experience, been on the other side of the table and being actively shorting stocks, it's part of the toolkit. Is what we do when we consider investments. We talk about having a variant perception and being very explicit about why we invest in a company. One of the ways to think about it is just to, as Charlie Munger always describes, to invert it. So we do see the things that have a short position. We always pay attention to what the short positions are stock, and more thinking out loud and discussing within the team, what would you have to believe to be short of stock? So it's always been a tool as for what we do on a day-to-day basis, because a heavily shorted stock is moving one way or the other. Not a big impact other than the pain and suffering, because so many of these things are in the Russell 2000. So that's been the but it doesn't change what we fundamentally do.
Brian, if I can go to you for this next question, you had nicely walked through, if people see page 9 here, about the consumer exposure, and I just looked at the portfolio right through the end of February, and you guys are kind of neutral to slightly overweight consumer. So people may perceive that, right, as some type of macro or top-down call, but working obviously with you guys as long as I have, it is purely bottoms up. So maybe without getting into the details of specific names, but just the process of canvassing how you went through finding mispricings, and because you have done quite a bit within that sector kind of already in the first 2 months here in 2021.
Sure. Yeah. Also, let me point out too that these sector weightings, when we do invest in the SPAC, prior to the merger being completed, they show up as financials, but they may actually be in other sectors. And we have, at this time, had consumer discretionary names that were represented as being in financials. So that's just a small point of clarification. But
no, that's great.
yeah, I mean, as Albert said, like we target where we are underweight, and we have known that consumer discretionary is a difficult area for us. It, obviously this last year was extremely volatile across the entire consumer discretionary industry, from, what the immediate drop in auto sales to then what became an auto sales boom, the immediate drop in casinos that had to close for 3 months, and now we're in the midst of a gaming boom again. The noise we've had in retail, both on and offline, it's been a really volatile area, which allows us to find opportunities, but it also means that it's just extremely difficult to sort of keep up. So we've been looking in various consumer discretionary and industrial areas for some time because we do want to be part of that trade, but we also realize that, as you say, we are not in the business of forecasting what the economy is going to do or what the market's going to do or where interest rates are going to go. We're in the business of observing where we are now and what we think the odds are in the future. So, we can say at this point, given the amount of confidence there is that we'll be reopening and there'll be a consumer boom coming up, we think a lot of that has been discounted in stocks, but you can still find, for example, home builders that are trading, only slightly above their tangible book value when they are, sitting on land that was bought at much lower prices and converting those into houses that are selling at extremely good prices right now. You could find industrial stocks like the container industry, which is very, very short right now, containers, that are trading below their tangible book value, and they're at the highs of lease rates that they've seen in a decade. So there are a lot of great ideas out there, and you don't have to go to a thing like GameStop. It's unfortunate that people are treating those stocks as a game. Things like MicroStrategy, where they issue $1 billion of equity to buy $1 billion of Bitcoin, like that's not anything fundamental that we want anything to do with, and it does switch the market around. But the great news is there are still a lot of really good opportunities out there that
yeah, Vinay, if I may add just one comment on that previous question. As far as the actual process, again, as we note things that we are underweight, as I said, we do prioritize doing work on that. So sorting through and doing the fundamental work in that first part of our process of embedded expectation in a wide number of securities led us to narrow down to a few that we did the in-depth work, and the time that it takes to do that and find good opportunities, that's what led to part of the closing of that gap, as well as what Brian described in terms of some stocks converting, as well as the performance of some previous holdings narrowed that gap tremendously. But the process was the same, and then the timing is what it is, however long it takes for us to get comfortable that we have a fair perception, that we understand the risks that we're taking, and we have a view of the probabilistic manner in valuing the company.
No, that's an excellent kind of add-on. Maybe I'll open this up for either one of you that wants to answer this last question that I had, which is if you go to the left part of page 9 that we have on the screen, what is notable is, and you guys, you wrote about Plug Power in your fourth quarter commentary. I had that correction, but it's still at $20 billion if I look at it right now on the screen. And you see that 18% of the market, the small cap market, is above $5 billion. And so I guess the question is more about how you're thinking about size or how you're thinking about your opportunity set for new investments, and has that had to change at all with some of these kind of moonshots that you've seen in the index, or just the overall rise in the indices themselves?
I'll go ahead and start, and Albert can get on if you'd like.
Yeah, go ahead.
It has, and it's been a challenge because the performance has been so concentrated in a small number of stocks that have now become mid cap or even bigger than mid cap. You are not seeing all of the equity the plug has issued, so it's actually a bigger market cap than even the 20 billion that you're observing. And good on them too, by the way. They raised $5 billion to fund a dream. Fantastic. I hope it works out for them. So we don't want to become a large cap or a mid cap fund. We do want to stay true to what we believe our investors want, which is that we are investing in small cap companies. It is the nature of small cap companies is changing to some degree as the market is expanding, and so we have let our market cap limits rise to some degree, but we are, we're still we will still maintain a small cap portfolio that, we're not going to get to June and have the Russell rebalance and have to say, oh shoot, now we need to sell all these mid caps at the end. We'll still be small cap and comfortably so when the Russell rebalances.
Yeah,
Albert,
just to add
Yeah.
a couple comments to add. One is the actual number. Our weighted average market cap today is about $3.1 billion. That compares, the Russell 2000 itself is nearly $3.8 billion. So from the start of this strategy, we've been committed to remain small cap, and that's what we've done. So when you look across these factors, whether it be, are you truly small cap, are you investing in high quality, low quality, I think that some of the nuances of what other strategies, or specifically even more so to index passive strategies, may be exposed to that some investors may not be aware. Brian had run some data. Just going to share one very quick anecdote. This is as of March 1st. There were 64 stocks in the Russell 2000 that were up year to date more than 90%. So these are the GameStops of the world, and they're highly concentrated, of which out of those 64, 80% of them are unprofitable companies. And that, again, going back to our point about options, real options, and volatility and cost of capital. So that's what we observed. Again, we continue to do what we do and find the opportunities wherever they may be. And as Brian pointed out, we like the opportunities we're finding at this point.
That's a really excellent observation because Brian, we were talking about this last week about the fact that just because value is outperforming growth doesn't mean that that's a monolith, right? There's certainly very narrow pockets, and as you said, to the point we were talking about with shorted stocks or those type of things, there's certainly a type of stock that, look, our job is to look at everything, but there are it's been a very interesting market as far as that type of number of names that are up that much on an extreme basis kind of year to date. Any closing thoughts for either of you guys kind of before we kind of close the call?
Yeah, I would say my closing remark is just, again, our objective today was to show some of the things that we're observing in the marketplace, as Brian hit it in terms of cost of capital and volatility that have created potential distortions in not necessarily that they are wrong, but currently priced in the marketplace. And then we see that as it relates to the construct of how higher quality assets are priced relative to lower quality assets. We believe all of that creates opportunities over time. Our process continues to be broadly applicable. I know we as a broader team continue to, as we both said, find good opportunities, understand the risks that we're taking, and we trust that over the long run, through stock picking, will deliver strong results.
Brian, anything from your end?
I think Albert said it.
Okay, so to those listening live or will be on the replay of this call, we just wanted to thank you. This week will mark a year for the three of us doing all these types of interactions virtually, and while Albert and Brian have probably enjoyed it a lot more than I have, I'm sure we, including the three of us, are all going through our various stages of virtual meeting conference call fatigue, and our partnership with you and our clients is what sustains our business. So we genuinely hope you found this call useful. Don't hesitate to give your client representative, whether at ClearBridge or at our parent company, Franklin Resources, feedback on how to make our future calls even better. With that, thank you and have a great day.